Welcome back to the channel, and thanks for joining me. I'm AlgoBot, and here we break down automated trading strategies for MetaTrader 5 in plain, everyday language. Today we're exploring an expert advisor called Fisher Transform Reversal. It's built around a lesser-known oscillator called the Fisher Transform, and it pairs that signal with a trend filter to time pullback entries. Over the next few minutes, you'll learn exactly how this strategy reads the market, how it decides when to enter and exit, and how it manages risk on every trade. Remember, this is educational content only, not financial advice. Let's dive in. So what exactly is the Fisher Transform Reversal Expert Advisor? At its core, it's a trend-filtered mean reversion system for MetaTrader 5. Mean reversion simply means it looks for moments when price has stretched too far from its recent balance and appears likely to spring back toward it. The tool it uses to spot those moments is the Fisher Transform, an oscillator designed by John Ehlers. Here's why that oscillator is interesting. Ordinary price movement behaves a lot like a random, heavy-tailed walk, so many standard oscillators smear their turning points across several bars, giving vague, rounded humps. The Fisher Transform first normalizes the median price into a band between -1 and +1, then pushes it through a mathematical function that stretches values near the edges of that band toward the extremes. The result is that a stretched market produces a sharp, clear spike instead of a lazy rollover. Reversals show up as a clean, early kink in the line, which is exactly what this kind of fade strategy wants to see. But the strategy never fades a trend blindly. That's the second key ingredient. A slow exponential moving average defines the market's regime. The expert advisor only buys a stretched low turn while that average is rising, and only sells a stretched high turn while it is falling. In other words, it turns a raw countertrend signal into a trend pullback entry, buying dips within an uptrend and selling bounces within a downtrend. Who is this style suited to? It's aimed at traders who prefer a systematic, rules-based approach and who are studying how oscillators and trend filters can be combined. Its natural home is a liquid major currency pair, such as EURIST or USDJPY, or a major index, on time frames from 15 minutes up to 1 hour. As always, everything here is shared for educational purposes only. Let's walk through the mechanics step by step. Everything happens on a single time frame, and the expert advisor makes its decisions once per closed bar, so it isn't reacting to every tick of noise. First, for each completed bar, the strategy calculates the median price, which is simply the high plus the low, divided by 2. Then it looks back over the FisherPeriod, 10 bars by default, and finds the highest and lowest median price in that window. It uses those to normalize the current median price into a value between -1 and +1, smooths that value slightly, and clamps it so it never quite reaches the edges. Finally, it pushes that number through the Fisher Transform formula, producing the gold oscillator line you'll see on the chart. Each new reading is compared against the previous one, and that previous reading acts as the signal line. Next comes the trend filter. The strategy calculates a slow exponential moving average with a period of 100 and measures its slope over the last 3 bars. If the average is higher than it was 3 bars ago, the regime is considered rising. If it's lower, the regime is considered falling. Now the entries. For a long, 2 things must line up. The Fisher line must turn upward, meaning the current reading is higher than the previous one, and that previous reading must have dipped below the lower extreme level, which defaults to -1.5. On top of that, the trend average must be rising. When all of that agrees, the strategy signals a buy. The short is the exact mirror. The Fisher line must turn downward from a previous reading that pushed above the +1.5 extreme, and the trend average must be falling. When those align, the strategy signals a sell. There are 2 more gates before any order goes out. The current spread must be no wider than the maximum spread setting, which keeps trading costs contained, and there can only be 1 open position per magic number at a time, so the strategy never stacks trades on top of each other. Finally, risk. Both the stop and the target are volatility adaptive, built from the average true range, a common measure of how much price is moving. The stop loss is placed at 2 times the ATR away from entry, and the take profit is set at 1.5 times that stop distance, giving a reward-to-risk ratio of 1.5 to 1 on every trade. Position size scales gently with the account balance, so the risk stays proportional as the balance grows or shrinks. And of course, losing trades still happen. The stop is what keeps each one contained. Let's look at the actual MetaQuotes language code that runs inside MetaTrader 5, shown here as it appears in the meta editor. At the top are the input parameters. You can see the FisherPeriod set to 10, the extreme level at 1.5, the TrendEmaPeriod at 100, and the slope lookback at 3 bars. Below those are the risk settings, the ATR-period at 14, the stop multiple, the reward ratio at 1.5, the spread cap, the base lot size, and the magic number that tags this strategy's trades. Just beneath the inputs are the 2 conditions that define the signal. The variable turn up is true when the current Fisher reading is greater than the previous one, and that previous reading was below the negative extreme level. Turn down is the mirror. The current reading is below the previous one, and that previous reading was above the positive extreme level. Now the long block. The code checks whether turn up is true, and we are in an uptrend. When that passes, it reads the ask price as the entry, sets the stop loss 1 stop distance below it, sets the take profit at the reward ratio times that distance above it, and calls trade.buy to place the order. The short block is the exact mirror. If turn down is true and we're in a downtrend, it reads the bid price, places the stop 1 distance above, sets the take profit the reward multiple below, and calls trade.sell. 2 clean, symmetrical blocks, 1 for each direction, sharing the same volatility-based stop and target logic on both sides. Let's bring the whole strategy to life on a chart. On screen, you can see a series of candles with a blue line running through them. That's the slow trend moving average, set to a period of 100. Below the price, in the subpanel, is the gold Fisher transform line with 2 dashed levels, an upper extreme at plus 1.5 and a lower extreme at minus 1.5. Watch how the 2 work together. We open in a gentle uptrend. Notice the blue trend average is sloping upward across these first candles, which tells the strategy that the dominant regime is bullish. That single fact matters, because this system will only consider buying while that line is rising. Now price begins to pull back. Over the next couple of candles, the market dips lower, and you can see the gold Fisher line diving down with it, sliding beneath the lower extreme at minus 1.5. In oscillator terms, the market has stretched into a deeply oversold condition, an exhausted move that has, historically, tended to snap back. But the strategy does not buy blindly into that dip. It waits. Watch the turn. On the next candle, price stops falling and closes higher, and the Fisher line hooks back upward. It is now higher than its previous reading, which was below the lower extreme. That upward hook, combined with the still rising trend average, is the exact long condition. The buy entry marker prints here. This is the heart of the idea. We are buying the dip of an uptrend at the moment momentum snaps back in our favor. As the position opens, the strategy places a stop just beyond the entry, a distance of 2 times the ATR below it, and a take profit set at 1.5 times that stop distance above it. Now follow the candles. Price pushes up, bar after bar, riding the trend it was aligned with. A few candles later, it reaches the take profit target, and the long trade is complete. Notice how the reward we aimed for was larger than the risk we took. That 1.5 reward to risk multiple is built into every trade. Now the market changes character. Watch the blue average. It flattens near the top and then begins to roll over and slope downward. The regime has flipped from rising to falling, so the strategy stops looking for longs and starts looking only for shorts. Price drops, then stages a bounce back up, a counter-trend rally against the new downtrend. As price bounces, the gold Fisher line surges upward and pushes above the upper extreme at plus 1.5. This is the mirror image of what we saw before. The market is now stretched into an overbought condition, but this time inside a falling trend. Again, the strategy waits for confirmation. On the next candle, the bounce fails. Price closes lower, and the Fisher line hooks back down. It is now below its previous reading, which was above the upper extreme. With the trend average falling, that is the exact short condition, and the sell entry marker prints. We are selling the bounce of a downtrend. The stop is placed the same way, 2 times the ATR above the entry, with the take profit 1.5 times that distance below. From there, price resumes its decline, candle after candle, until it reaches the short take profit target and the trade closes. So across this single chart, you've seen both halves of the strategy. A long that buys a stretched low Fisher turn inside a rising trend, and a short that sells a stretched high Fisher turn inside a falling trend. In both cases, the oscillator finds the stretched moment, and the trend filter makes sure we are fading with the larger move, not against it. Of course, not every signal plays out this cleanly. Losing trades are a normal part of any strategy, which is why the fixed stop sits on every entry. And that brings us to the end of our walkthrough of the Fisher Transform Reversal Expert Advisor. We've covered what mean reversion means, how the Fisher transform turns stretched price into a sharp oscillator signal, how the slow moving average keeps every trade aligned with the larger trend, and how the ATR-based stop and target manage risk on each position. Remember, this video is educational content only. It is not financial advice, not a recommendation, and not a solicitation to trade. Trading carries real risk, and losses are a normal part of it. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like me to analyze next, and subscribe for more MT5 strategy breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.